If you're planning to sell your business in Canada, you have a lot of options when it comes to tax planning. But today, we're zeroing in on one of the most powerful and, honestly, one of the most preferred structures that tax pros use, the family trust. So let's dive right into how this tool works. And just before we get started, a quick credit for the preparation of this explainer. All right, here's our game plan. First, we'll look at the big problem that business owners run into. Then we'll introduce the family trust as the perfect solution. We'll break down who the 3 key players are, cover the 6 huge benefits, and then wrap up with a final thought on strategy. Okay, so to really get why the family trust is such a game changer, you first have to understand the problem it's built to solve. And that problem revolves around something called bad assets. Look, it doesn't matter if you own your company directly or through a holding company. You eventually hit the same wall. Over time, your successful business builds up assets that aren't core to its operations, like a big pile of cash. These are the bad assets, and they can actually stop you from qualifying for the lifetime capital gains exemption. That's a huge tax break to lose. And with a holdco, it can get even trickier because the bad assets can pile up in both companies, and a buyer might have to take the whole thing, baggage and all. So how do you get around this? Well, this is where tax professionals bring out the elegant solution, what's really become a preferred structure for this kind of advanced planning, the family trust. Let's see exactly how it works. So what is a family trust, really? At its heart, it's a legal relationship. Think of it like a special box. Instead of you or your holding company owning the shares of your business directly, you put those shares inside this box, the trust, which then holds them for the benefit of your family. Now, a trust isn't just a document. It's a living arrangement between 3 very distinct parties. If you understand these 3 roles, you'll understand exactly how the whole thing operates. First up, you have the settlor. This is the person who kicks the whole thing off by legally creating the trust. They do this by giving a small piece of property to the trustee. And it's almost always something symbolic, like a single gold coin and never cash. Why? Well, it's a clever way to sidestep some tricky tax rules down the line. Next, you have the trustees. These are the managers, the decision makers. They legally hold the property, in our case, the company shares, and they're in charge of managing everything. Usually, this is the business owner, but it's a really good idea to have other trusted advisors or friends as trustees too. And finally, we have the beneficiaries. These are the people the trust was set up for in the first place. They're the ones who get the distributions from the trust, whether that's income, dividends, or capital gains. And here's a crucial strategic point. A holding company can also be a beneficiary. This little detail is the key to keeping the main business clean and ready for sale. We'll see how in just a moment. Okay, so we've got the structure down. Now for the really exciting part. Why would you go to all this trouble? Let's get into the strategic payoff and look at 6 powerful benefits. This right here is where the magic happens. It's all about multiplication. So the lifetime capital gains exemption, or LCGE, lets one person earn a huge capital gain tax-free. Let's use $800,000 as an example. With a family trust, you're not stuck with just one person's exemption. If you have, say, 5 family members as beneficiaries, you can potentially multiply that exemption by 5. That's a $4 million gain from selling your business, with 0 tax. This is, without a doubt, the single biggest reason to use this structure. So how do you make that happen? Well, it starts with something called company purification. Remember those bad assets, that excess cash clogging up your operating company? By making a holding company a beneficiary of the trust, you can move that cash out of your main business and into the holdco as a tax-free dividend. This keeps your operating company pure, lean, and qualified for the capital gains exemption. And that leads perfectly into the next huge advantage. Because that holdco's only job is to hold the passive cash, you don't have to sell it. A buyer can come in and just buy the clean, efficient operating company. This makes the sales so much simpler compared to a traditional structure where a buyer might have to acquire a company full of assets they don't even want. So let's connect the dots back to that big, beautiful number. When you sell the purified opco, the capital gain happens inside the trust. The trustees then allocate that gain out to the different family beneficiaries. Each of those family members can then use their own personal LCGE to shelter their piece of the gain from tax. And that's how you get that incredible multiplication effect. You know, another great thing here is that you're not locked into this forever. This isn't some permanent, unbreakable decision. If things change in your business or your family, there are ways to unwind the trust structure. It gives you a powerful strategic path forward, but it's not a one-way street. Most of these are set up as discretionary trusts. And what that means, in simple terms, is that the trustees, usually you, the business owner, get to decide who gets what and when. So if one of your kids is more involved one year or another has a bigger financial need, you have the flexibility to adjust the payouts each year to match what's actually happening in your family. And finally, the trust itself is basically tax neutral. Think of it more like a pipe than a bucket. As long as all the money that comes into the trust flows out to the beneficiaries in the same year, the trust itself pays zero tax. This avoids any double taxation and makes sure the money is only taxed once when it gets to the people who are actually receiving it. So let's pull all of this together. When you step back and look at the big picture, what's the key takeaway? Here's a final thought on the strategy of it all. This is a top-tier planning tool for a reason. Professionals love it, not just for what it does on its own, but for how well it works with other strategies. For instance, you often set up a family trust at the exact same time as an estate freeze. By combining these moves, a business owner can tackle multiple huge goals: tax planning, succession planning, all at once. It's just incredibly efficient. Which really leaves us with this final question to think about. For any business owner who's planning for that eventual sale, a family trust isn't just some small optimization. It can be the absolute key to unlocking the true value of your life's work and, just as importantly, securing the financial future for your entire family.